Hi, welcome to my channel. My name is Gil Rossi, investor and funds manager. Today I want to share with you my valuation and analysis of Netflix. As you may know, Netflix has been under pressure. The stock has dropped 43% since the max at November 17, 2021. This was the same time that Disney reported fourth quarter results, and of course they were a bit soft, so it has spilled on all streaming services like Netflix. Also, there has been pressure to growth stocks due to the potential increase of interest rates sooner than expected, but the big drop of 21% in one day came on Friday, just after they reported fourth quarter results. And the problem here was that they missed on new subscribers, and some analysts and investors have doubts about the ability to keep growing as they have been doing in the past. As we can see here, some analysts like Evercore ISI, which has been a multi-year bull on Netflix, to cut the rating to inline from outperform, and also Morgan Stanley cutting the stock to equal weight. The same thing happened with Credit Suisse, which downgraded the stock from 740 and outperform to 450 and neutral. So a big drop on target price for almost 40% drop. As you know, my analysis is divided in qualitative and quantitative portions. I'm going to focus on the quantitative analysis here, which includes the projections and the calculation of fair value and IRR. But I'm going to touch on the past performance because it's the basis for making the projections. And I'm going to also talk about management and competitive advantages briefly, but mainly this is going to be the focus, the quantitative analysis. So let's start with the letter to shareholders that they publish in their investor relations page. And if we go to the first page, we see here at the beginning, it looks all right. Full year revenue of 30 billion, grew 19% year over year. Operating income 6.2 billion, rose 35% year over year. And they finished with 222 million paid members, 8.3 million higher than the previous quarter. And this is in line with what they forecasted, 8.5 million additions in the third quarter. So, but the problem really came with this forecast. The forecast for the next quarter of 2022 of 2.5 million. The expectation here was 5.8 million by the street. And this expectation of 5.8 million came from, if we go to this table that they present every quarter, the one of the third quarter 2021, we can see here that these are the 17, 18 and 19 years, pre-pandemic years. And they have been quite consistent, reaching roughly between 25 and 30 million subscribers, new subscribers per year. So I think analysts and the investors thought that this year 2022 is going to be similar to pre-pandemic 2017, and they expected 5.8 to be the additions that they were going to guide, but they came with 2.5 as we saw, so versus the 5.8 that was expected. And this, I think, is the main problem, because if you think that this is Netflix reaching a limit on growth, of course you're going to project that into the future, and the stock is going to, the fair value and everything is going to come down. Let's go to Netflix Investor Relations YouTube channel, where they upload all the conference calls, and they have a very good format. They have one analyst per every 3 or 4 quarters to conduct the interview, and management answering questions from that specific analyst. I think it's a much more efficient and effective way of doing it. If we see here 14,000 subscribers, 15,000 views, 15, 20, 24,000 views. And this is just on the sideline, but there are 4% of individual shareholders of Netflix. So that means that a company of 176 billion means 7 billion is held by these individual investors. If each of these individual investors has, let's say, on average 20,000 in their account, this means 350,000 individual investors. And if you compare that with 15,000 views, that means that there are like 330,000 individual investors that are not checking the conference calls. This is just on a side note, just an interesting thing that I noted. So let's go back to this and check the latest earnings interview. It's going to be conducted by Nidhi from Fidelity, and I'm going to show you the explanation that they give to the 2.5 million. It's going to come from Spencer, the Chief Financial Officer, and Reed Hastings, which is the co-founder of Netflix. Let's have a listen.
And as we look ahead to Q1, the guidance was a bit below kind of what was expected and what you've done in previous Q1s. Maybe just help us understand what some of the key considerations were that went into the guidance, and does it raise any concerns for you about anything structural, whether it's competition or saturation, or does it give you any pause in terms of sort of your return on content spend?
Sure. No structural change in the business that we see. What's reflected in the guidance, we guided to 2.5 million paid net adds in Q1. And what's reflected there is pretty much the same trends we saw in Q4. So healthy retention with churn down, healthy viewing and engagement with viewing up, and acquisition just growing, but a bit slower than pre-COVID levels. Just hasn't fully recovered. And we're trying to pinpoint what that is. It's tough to say exactly why our acquisition hasn't kind of recovered to pre-COVID levels. It's probably a bit of just overall COVID overhang that's still happening after 2 years of a global pandemic that we're still unfortunately not fully out of. Some macroeconomic strain in some parts of the world, like Latin America in particular. While we can't pinpoint it or point a straight line when we look at the data on a competitive impact, there may be some kind of more on the marginal kind of side of our growth, some impact from competition, but which again, we just don't see it specifically.
Let me pause this video for a minute and show you what the newspapers were saying about this last comment from the CFO. From Barron's, which is a magazine that I respect, the company also said that competition may be affecting our marginal growth, a slight but notable change in tone about the risks from rivals. And here from Yahoo Finance, they said, still Netflix acknowledged that competition may be affecting marginal growth some during its earnings call on Thursday night. I don't know about you, but the way I see it, if I read the newspapers and don't watch the conference call, I will have a different impression about what's going on with the company. I think that newspapers were a little bit exaggerating and took some of the comments out of context. Probably it's me, but I think that sometimes they want to, of course, make news. In my view, it's much better to go to the source and listen exactly to what the management had to say. Have a listen again to what he had to say and check whether you feel the same, that his comments were a little bit exaggerated.
Competitive impact. There may be some kind of more on the marginal kind of side of our growth, some impact from competition, but which again, we just don't see it specifically. So overall, that's what's reflected in the guide. I'd say our big titles are also landing, at least our known big titles, a little bit later in the quarter with season 2 of Bridgerton in March, The Adam Project also in March. And I should note, we also, while we are changing prices in countries every quarter, in Q1 of this year, it happens to be our largest country, as we announced last week, and actually our largest region with Canada as well. So that's probably a little bit more impact than a typical quarter.
But Nidhi, you're right to reflect on, 2 years ago, we were 10 million above plan, which was a shock, Last year we were 10 million below, or 9 million. And so, the pull forward sort of, makes it hard to read. In the prior years, we were very steady, so we could have confidence on incremental trends. But as Spence said, when we reflect, of course, hey, that's a low guide, and we think it'll be accurate. It's not sandbagged at all. Kind of what's going on. And, there's a number of, potential explanations in COVID, but then we worry about hanging too much on that. There's more competition than there's ever been, but, we've had Hulu and Amazon for 14 years, so it doesn't feel like any qualitative change there. And overall, confidence in streaming becomes all of entertainment, linear dissipates over, the next 10 to 20 years. Very high confidence in that thesis because everyone's coming into streaming. So like market size, very large. Our execution, is steady and getting better. So for now, we're just like, staying calm and, trying to figure out, again, the COVID has introduced so much noise. It just wants us to give it some pause and as we work on everything we've always worked on.
So the main takes I see here from the CFO are the following. First, that there's no structural issues. Competition may be a factor, but they cannot yet pinpoint it to be the culprit. Content is coming towards the end of the quarter, and normally when you upload content, you have the possibility of more subscribers coming. That's why content is so important, and you have to keep feeding it because that's the way that you keep adding subscriptions. But because it's going to be towards the end of the quarter, probably that has an impact on the growth for this quarter. There is healthy retention, engagement, and viewing, which is really positive. I think this is more important than subscription growth. And he thinks that the main reason could be attributed to noise from the pandemic. And the co-CEO, the founder, main takes are, first of all, he's saying that this is an accurate guidance, it's not a sandbagging. There has been over expectations sometimes and under expectations in the past. Like, for example, if we see a couple of quarters ago, when we started 2020, they were expecting 7 million and they actually produced 20 million. Of course, 2020 was an atypical year, but it shows that this is not a linear thing like we can see here. He has high confidence in the linear to streaming conversion. There's a tailwind that will last for decades. There is more competition, yes, but they have been competing with Amazon for over 14 years, so he doesn't see any problem in tackling, let's say, competition. And also he's saying that the market is really large and they're executing very well. A little bit more information about the subscribers by geography. You see all of them are growing nicely, even the US in blue. In terms of additions by geography, also I don't see any trend that shows me that they are declining. You see that they are quite volatile, but they are up and down, but no specific trend. In terms of annual revenue per user by geography, well, the highest and growing also is the US and Canada, and the lowest is Latin America. This is mainly due to the valuation. The currencies in Latin America have devalued quite substantially in the last couple of years. But on average, if you see, it's growing from 10.5 2 years ago to roughly almost 12 per month per user. So this is a good sign, meaning even as the company grows more on, let's say, lower RPU countries, they are still able to grow the average RPU overall. So here I'm showing the RPU and also the members, both of them growing quite nicely. Especially the members grew almost double from 120 or something like that to 220. So it's in 3 years. This is an amazing growth. I don't think that the ceiling is close, because if the ceiling were to be close, this wouldn't be shooting up in a straight line like this. It should be starting to asymptotically, let's say, reach the ceiling. And with that in mind, what I did was I went to the broadband subscriptions from the World Bank. In 2020, 33% of China had a broadband subscription, and 17% of the world. To have an idea of how much, potential total addressable market, we can say, from Netflix there is in the world, ex-China, of course. So I have to subtract China. So I came with this following calculation. So if you go to the population in 2020, this is the population of the world. I have to subtract China. So if I multiply this by the number of the percentage of broadband subscriptions, households, and I subtract this is the calculation. 7.7 times 17% was the percentage of broadband households, less 1.4 billion times 33% gives me roughly 800 million homes are the potential target of Netflix. Of course, Netflix is not in every country, and not everybody with a broadband access will be able to pay or will be able to get Netflix. But this is just an estimation and an idea. And this, if I do that for 2031, this is the World Bank's estimation of population in the world for 2031, 8.5 billion people. I'm going to use, instead of 70%, 25%, because that penetration of broadband is growing roughly 1% per year, and also in China is growing fast. So these numbers could be even larger in 10 years, but let's assume these are the numbers. It's 1.5 billion homes will have broadband access in 2031. So this means 6% growth from today's level. So this is sort of like to have an idea of the large market that Hastin was mentioning. So 6% would be the growth of subscriptions, let's say, assuming that Netflix keeps the market share that they have been having. And if we add 3%, I think is what I'm going to expect as a growth of ARPUs, so average revenue per user, which is in line with inflation. It would give me 10% growth of revenue, which is what I'm going to assume in my calculations. From the shareholder letter, also they show this table where from Google search they place the 10 largest searches for TV shows and movies, and you see 8 are of Netflix and 2 in movies. And these are the competitors. Disney has 2 here, and here it has 3. And Warner Brothers has 2. So if we check the previous year in the same letter, but for 2020, all of them except Big Brother Brazil were for Netflix. So we can see some pressure there in TV shows coming from other companies. But in movies, they still have 2, the same as now. They also mention the operating margin. As you can see, it's been growing quite nicely, and roughly 300 basis points per year. This is what they will expect. And they are saying here that this, instead of being 22%, which would be the trend, they are expecting 20 or 19%, and mainly due to the dollar strengthening and the estimation of 2 percentage points negative impact on operating margin from forex pressure. So if there were not this pressure, then they would be targeting the 22%. But the good thing is that they are still see no change in their goal of steadily growing the operating margin at an average increase of 3 percentage points per year over any few year period. Of course, this is not sustainable for the long term, but at least in the near term, this is a good sign. Let's see the CFO discussing the margins, growth, and capital allocation.
No, it's really just FX, Nidhi. So as we said in the letter, yeah, we lost about $1 billion of expected revenue in 22 through FX. That's about 2 points of margin. So if you just kind of look at our guide and add that back on, we're right on our pace of adding about 3 points of margin per year. And can't forget, we were over delivering on margin the last couple of years. So that's really all that's happening here. And the FX move happened in really the last 6 months of last year. So what we've always said is we don't want to swing the business unnecessarily fast. We want to be able to invest in a healthy way into our growth opportunities. So, and over time, we will then right size appropriately our investment levels, our cost structure, our pricing in order to right size for where the currencies are coming in. And so this gives us some time to do it. So it gives us a little time. We will catch back up. We're still committed to roughly three average of 3 points of margin increase over any few year period. But there's no change there. We've been factoring in our content investment, our games investment all along. And I just want to say in our growth too, we talk a lot about this deceleration. Obviously, we'd like to grow faster, but there's still very healthy growth in this business. What you're seeing in, we ended the year last year with 19% growth year over year. What you see in the guide is 10% revenue growth for Q1, but that's a bit misleading again because of FX. There's about 4 points of drag in our revenue in Q1. So the what I would argue, FX adjusted constant currency for Q1 year over year is about 14% growth. It's also a tough comp year over year in Q1 because you may remember we increased prices in the US in Q4 of 20, which flowed through to Q1 of 21 is when it was really materialized. So the year over year comp is tough. So the underlying organic revenue growth in the business is right now, at least in Q1, more like 15% plus, 15, 16, 17%. So that's now that's at least just in the quarter, and that's still very healthy underlying growth in the business. I don't want to dismiss that. We'd love to be growing faster. We'd love to not have the negative FX swings, but it's still very healthy growth in the business.
It's very exciting that you'll become sustainably free cash flow positive this year. Congratulations on reaching this milestone. I feel like I've been waiting 10 years to ask this question, but how will you balance M&A and buybacks with your free cash flow? And maybe sort of related to that, have we peaked in terms of that ratio of cash content spend to amortization? And how long will it take for earnings and free cash flow to kind of converge?
I can't believe you wanted to end with me, Nidhi. There's so many more exciting people to speak with on the call. So we appreciate what you said there. It is a big milestone for us to be cash flow positive going forward. We're excited for that. The business model has been proving out, so that's great in terms of our increasing profit margins over time, as well as cash. In terms of use of cash, and Spencer, you can chime in too, but as we've talked about in prior calls, our top priority is to be responsible stewards of the business and our cash, but to invest in the healthy growth of our business and strategically invest in the business. First, organically, if there's then opportunistically M&A, M&A is not the strategy for us per se. M&A is a tactic to accelerate our strategy, whether it's to accelerate our content capabilities and capacity, or just acquisition of IP like Dahl across film, TV, and games, as you've seen. And what's left over after that, we're not going to sit on excess cash. As we've said, our capital allocation plan is as it's been, which is to have roughly 2 months of revenue in the form of cash on our balance sheet, and excess beyond that we'll return to shareholders opportunistically, as we have done. We did that to the tune of about $600 million last year in share repurchase, and we're authorized up to $5 billion share repurchase. So that's still our plan. In terms of when the those ratios converge and earnings and cash flow look the same, I don't want to put a prediction out there. We're still very much in growth mode as a business, so it will continue to converge over time, but I don't want to declare a specific peak. It's been going in the right direction over a multi-year period, and it'll continue to do so.
Another thing that they mentioned in the letter is that they are going to be free cash flow positive in 2022 and beyond. So it's a good sign that the business is already transferring from a growth stage into a more mature stage, but still with high levels of growth. One thing that I like, and then he mentioned in the clip that I just showed you, is the way that they allocate capital. First of all, they focus on growing the business and content. Then, after that, pay debt if necessary. And only after that, they are going to opportunistically buy back shares. They are not mentioning distributing cash to shareholders via dividends. And this is something I like, because I think that share repurchases is a much more efficient way to return capital to shareholders, much more flexible for managers, and also it provides another opportunity to create value when they are buying back shares at a discount in the market. So I have a video about all this, a 4-series video that you can check why I think that way. So let's now go and check the income statement for the last 10 years in graphical form. You see revenue has been growing quite nicely. Margins are improving, and as we saw, the expectation is that they will keep improving in the near term. In terms of cash flow, operating cash flow has been negative. Only now it's starting to show signs of some years of positive, and as we saw, it's going to be positive from 2022 onwards. That's their expectation. The capital expenditures are not that high, as you can see. Operating margin, operating cash flow, and free cash flow is very similar. All the investment that they do in content goes to the income statement. Nothing to say here about the cash flow, other than it's good to see that they are turning the corner into becoming cash flow positive. Let me talk a little bit about the competitive advantages. I think that Netflix has a network effect, and the network effect to me is one of the best advantages to have in a company. The way I see it is they have great content and great streaming prowess that attracts subscribers. And of course, the more subscribers you have, the better content and streaming prowess you can have, because you have lots of fans and data that will allow you to improve on here. Like, for example, in terms of funds, they're expecting to spend 18 billion in 2022 in content, while, for example, Disney is going to reach 14 billion in 2026. So they are ahead in that area. But then also, the more content, the better you are in content, and the more subscribers you have, the more creators and artists that you attract, which of course creates better content. So here you have also a loop, flywheel. This one is self-fulfilling, but this one is not self-fulfilling. This one you have to be feeding it with content all the time, and also keeping your technology at the top of the top class. So it's not that strong of a network effect, because the moment you stop feeding it, this one will fizzle. So that's why I feel that the network effect is roughly a little bit more than medium. Let's now talk about the projections. And on this report of Credit Suisse that I showed you at the beginning, where we saw that they have downgraded the stock, they attributed the problem, let's say, of this quarter to 2.5 million net adds being a complete surprise to them. And that triggered a reduction of net adds by 7 million or 7.3 million for 2022 and 2023 and onwards. So from 26 million roughly, they reduced it to 18 or 18 and a half. So roughly 1/3 of the future growth that they were seeing in the coming years was reduced due to this surprise. And they show a very nice table where you can see Credit Suisse expectations and the street expectations. And if we add the 222 million that they have in 2021 subscribers, we add the expectation per year of Credit Suisse, they will reach 316 by 2026. And the street is expecting 344. I think that this is going to be reviewed as well after the report. Probably this is a little bit outdated. But this is a 10% roughly reduction of subscribers for 2026. I'm going to use this plus other reports I've been checking. I'm going to use 310 million for 2026 subscriptions. If you see here, I am my projections. I'm going to use 310 for 2026 from the 222 that they achieved in 2021. That's a 7% growth per year. So I'm going to keep this growth of 7% per year for the next 5 years. And in terms of RPUs, 11.72 was on this last quarter, and I'm going to assume 3% growth, so 16, almost 16 for December 31, and this is going to be the basis. These two numbers are going to be the basis for my calculation of my revenue. So let's go to the income statement. This is the past income statement, and this is what I am projecting. As you see here, the projections are coming. The revenue is coming from the previous slide that I showed you. Operating income is coming from an assumption of operating margin I'm making is 20%, which is what they are expecting for 2022, and I'm making it grow 1% per year. Even though they think that it's going to grow at least 3% per year on the next few years, I am going to be more conservative here. So this is the way I come to a EBITDA of 27 billion for December 2031. In terms of the cash flow statement, this is the previous cash flow statement, the previous 10 years. And I'm assuming because they are starting to be positive from very low numbers, I'm going to make it grow fast in the first few years, but then I'm going to taper that growth to 11%, and so the operating cash flow is going to be roughly 14 billion in December 2031. The capital expenditures to revenue is going to be in line with the past, 2%, and that is how I reach this free cash flow, which for 2031 is going to be 12 billion. Checking with Credit Suisse projections, just to have an idea of what other people is doing. If you see for 2029, 21 billion in EBITDA and free cash flow 14 billion. So I am assuming 12 billion. So for 2029, 10 billion, my free cash flow. And my EBITDA for 2029 is 21 billion. So similar in terms of EBITDA, I am a little bit, more conservative, 10 versus 14 in free cash flow, but still in the ballpark, I think. So that way I can compute the 10-year target price. So using the EBITDA and free cash flow that I just showed you, with these ratios, I come to enterprise value. Net debt, I am assuming in 2031, I subtract from enterprise value, I get market cap, divide by the weighted average shares outstanding. This is my share price based on EBITDA and based on free cash flow, and this is the average, 691. This 15, you see here, EBITDA, enterprise value to EBITDA has been lately a bit higher than 15, and in terms of sales it's been growing, you see, but on average 6.5. So if I assume 15, the enterprise value to sales is going to be 5 on average. So I think it's 15 seems a reasonable number to assume. And in terms of this 21 is coming from, if you assume an 11% growth, which is the last year of 2031 growth for free cash flow, and I bring that down to 5 and then to 3 in perpetuity, a company with 100 in free cash flow will have 2.14 in enterprise value. So this 21.4 is the way I compute this. So okay, this 691 average is what I'm going to use for my fair value calculation. So if I buy at 398 today and sell at 691, and I receive this adjusted free cash flow per share, this will be the free cash flow that I'm going to have as an investor, will give me, buying at 398, 8.67 IRR. So if I want to go to roughly 10% or a bit more than 10%, somewhere here, they would give me the fair value that I am willing to pay. So 334 to 360. So still, to me, is a little bit overvalued, even after all this 43% drop that we saw in the last 2.5 months. And now let me show you Netflix and next to the Walt Disney Company, which are something that I compared last time for the Walt Disney video. And I said that if you compare market cap of these two companies, you are getting similar business in terms of streaming and size, but Walt Disney has much more, you know. So the difference of these two in market cap would be all the parks and all the other businesses that Walt Disney has that Netflix doesn't have. When I did the Disney video, the difference was not that big, but now there's a big higher difference, you know, 176 to 250. And if you compare this, Walt Disney at that time, when I made the video a couple of weeks ago, I thought that it was valued roughly 155. And now it's in 137, so roughly here. So you would get a 10, 11 almost % return. So I think that Disney is in a sort of like a good position to be added to the portfolio. Netflix, I think, still a little bit, you know, overvalued, I think, even after all this drop. So, well, that's my view of the Netflix analysis. The 2.5 million that they are projecting is not a very big issue to me, but the problem is that the company has been quite overvalued in the past, and even with all this big drop, it is still a little bit overvalued, but it's almost fairly valued. So if you really like this company, I think it's a good moment to enter. But yeah, it's a company that has been very overvalued, and probably I would I'm not sure whether I would be investing at these prices. I think I need a little bit higher margin of safety. Okay, so I hope you get this some information from this, and you learn something from this. If you like this video, please give it a like, and if you haven't yet subscribed to the channel, please do so. And I hope to see you soon for another valuation video in a couple of weeks. Thanks very much for watching. Bye bye.